Hi, everyone. Today I'm going to be talking about the Caribbean economic outlook for 2020 and share my thoughts with you on what's likely to happen this year and how are things likely to develop. Um, and to do that, in the first place, we need to start off by looking at what the global economy is displaying and how that is likely to affect us in the Caribbean region. Now, I recently wrote a piece on the global economy at in my monthly Caribbean economic report, and you can subscribe to that Caribbean economic report that I put out pretty much on a monthly basis by going to marladukharan.com/insights, and it's a free monthly report. And on the last edition, which was December 2019, I talked about the fact that global growth is slowing down, and as the IMF put it, has slowed down to the lowest level since the global financial crisis, which took place in 2008 and into 2009. And so that growth rate for last year for the global economy was roughly around 3%. And as the slide shows, you can see that in 2008, we were also at 3%. And then there was a contraction of just about 0.1% in 2019. Now, I have postulated that this is not, even though the IMF says that global growth of 3% or less is considered to be a global recession, I am saying that even though 2019 we're expecting that global growth would have recorded around 3%, I'm saying that this is not even just a recession. Because if you look at what the growth rate has been for the past 10 years, it has really been not just slower growth than we would normally expect to see, but it has also decelerated. From 2017 into 2019, growth has actually declined. And so I'm saying that we're not just in a recession. I'm saying that global growth is actually in what I would call a great stagnation, meaning that it has really crossed the boundaries of what just a recession looks like. And this is likely to continue into the foreseeable future, simply because there hasn't been, unlike the global financial crisis in 0809, there hasn't been a coordinated policy response to this recession or stagnation, in any event, this economic slowdown that we are seeing in the global economy. And this lack of admission that there is a problem and this lack of policy response means that it's not being addressed meaningfully, certainly not in a coordinated fashion as you would address any global phenomenon. It might be addressed on individualized local levels, but certainly not, we're not seeing the global policy response that we saw to the global financial crisis, for example. And in my monthly report of December 2019, I discussed what the possible reasons were and what the possible outcome is. So this global stagnation, if you will, is going to continue to have implications for the regional economy here in the Caribbean. So let's switch now to talk about regional growth. As you would see, in terms of what the expectation for growth was in 2019, most of the economies in the Caribbean are already recording positive growth. Now, some of the countries here that you would see on this slide have been recording positive growth consistently for a number of years. But there are some that, for example, Dominica at 9.4%, really that is a reflection of the recovery effort following Hurricane Irma and Maria just about 2 years ago. So that 9.4% is not reflective of the economy actually growing beyond where it was a couple of years ago. It's really them trying to get back to where they were based on their recovery efforts underway there. But apart from the exceptions, most of the Caribbean is growing at fairly moderate levels. Now, how is that likely to play out and continue into 2020? So on the next slide, you will see that, for example, Guyana is going to grow at a pace of about 86%. That's the projection for this year. It is going to be the world's fastest growing economy, and it's going to grow at a pace of about 10 times the second fastest growing economy in the world this year, which is South Sudan. So it is really a huge outlier on a regional, but beyond that, global scale. And that's simply because Guyana is now an oil producer, and that's going to make their economy take off in terms of growth. Now, the rest of the Caribbean, as you see on the chart, will continue to show positive growth this year. Most of them. We do have Bahamas and Puerto Rico that are projected to contract. Barbados is going to record, well, expected to record positive growth this year, whereas they would have contracted last year based on the adjustments with the BERT program. So really some I guess, positive and optimistic growth numbers we're seeing for the Caribbean for 2020. So now let us switch to discuss each of these countries at an individual level. Before we get to the individual level, though, I'll just, as an aggregate for the ECCU, to discuss what's happening there. Now, there are a few countries in the ECCU that are still dealing with the after effects of hurricanes, but by and large showing positive growth. And on average, growth was about 3.5% in 2018, resulting from strong tourism and citizenship by investment program inflows. The IMF is projecting that growth in the ECCU as an aggregate will slow to about 2.25% over the medium to long term. Bank credit remains weak in spite of excess liquidity. Stayover arrivals grew by 14.6% year over year from January to September last year. Arrivals to Anguilla, for example, doubled year over year, and Dominica recorded growth of about 61%. And both islands are recovering, of course, from the effects of the hurricanes in 2017. Arrivals from the UK are not showing declines and have grown by about 10.6% year over year in the first half of last year. So that's telling us a bit about maybe the effects of Brexit have waned. Now, tourism visitor spending for the ECCU grew by about 9.3% year over year from January to September 2019. And the IMF found last year that removing supply side constraints is the best way to improve competitiveness in tourism in order to attract more arrivals to the Eastern Caribbean. And these supply side constraints are, for example, electricity and transportation costs, import tariffs, doing business indicators, improving access to credit, etc. On the chart, you're seeing the debt to GDP ratios, and this, I think, remains the critical drag on growth in the Eastern Caribbean. And of course, they are making an effort to bring this level down. There will be elections this year in Anguilla, in St. Kitts and Nevis, and St. Vincent and the Grenadines. Moving on now on the next slide to the Bahamas. In the Bahamas, the first half of last year, the tourism growth partially offset the effects that we would have seen in the second half of last year based on Hurricane Dorian. Construction material imports based on the recovery efforts will actually partially offset the gains of the growth gains of the reconstruction activity this year. Unemployment is set to rise in the Bahamas this year. And of course, fiscal deterioration is expected as the government spends a lot of money on the reconstruction effort. Now, in 2019, we saw the most recent example in the region of the catastrophic losses caused by climate change in Hurricane Dorian, which totaled over 3.4 billion US dollars in losses and damages. Over 80% of the Bahamas' archipelago's landmass is less than 5 meters above sea level. And this was the most intense storm in terms of wind and storm surge that the Bahamas has ever recorded. The private sector absorbed approximately 90% of the losses, with major damages to housing at about 1.5 billion US and tourism infrastructure at about 529 million US. Insurance receipts related to Hurricane Dorian will help offset the outflows of imports and related to imports for construction materials, and balancing those imports with the output from the construction sector activity is really what will underpin growth this year in 2020. As I said before, employment will be affected as a result of the temporary reduction in the tourism capacity related to the effects of the storm. Social welfare needs, reconstruction of lost infrastructure, and replacement of fixed assets will put pressure on the fiscal accounts this year in the Bahamas. Moving on now to Barbados. So Barbados is currently in the BIRT program, which is in conjunction with the IMF. And part of that program is the target to achieve a primary fiscal surplus of 6% of GDP this year. And Barbados is on target to reach that target. Now, the state-owned enterprises are being reformed, and that's a key reform with respect to achieving the fiscal outturn and the fiscal sustainability that Barbados needs. Unemployment is rising in Barbados. Construction and investment is still relatively weak, and we need to see further pro-competitiveness, pro-doing business reforms in order to reverse that weak construction and investment that we're seeing. The size of the construction sector was about 20% smaller last year than it was on average between 2006 and 2015. So the construction sector has some way to go to get back to where it used to be. And the economy is expected to have contracted again last year, as I highlighted earlier, based on the reforms, especially the fiscal reforms. But we will likely see growth this year, albeit at a weak pace, not exceeding 1.8% through 2024, as predicted by the IMF. Stayover arrivals through September 2019 were up 4.2% year over year, accelerating over the 2018 number. Now, this is actually expected to increase further this year, based partly on an initiative called We Gathering, which is looking to attract Barbadian diaspora and their friends and families to visit Barbados this year. So all in all, Barbados is meeting its targets under the BIRT program, and we are expecting to see the positive results of these reforms bearing fruit this year, 2020 and beyond for Barbados. Switching now to the Cayman Islands, of course, my favorite country in the region and of the most well-run economy in the Caribbean. Only good things to say. GDP is expected to grow by about 2.2% on average over the next couple of years. And this is, by the way, alongside continued fiscal surpluses. I recently retweeted something that the government put out around the fact that they are paying down their debt. And I've had a lot of questions come to me around how is it possible that the Cayman Islands can pay down debt, can run fiscal surpluses, and yet still continue to display positive growth and stability and consistent good performance for the past several years. And I will refer you to a webinar that I had done with the current Premier and the current Minister of Finance a couple of years ago that answered these very questions. But I would just say briefly that really, fiscal spending, especially fiscal overspending and expansionary fiscal policy, that is underpinned by deficits does not generate growth sustainably in this region. And this is a matter that I've spoken to in general terms, not just in relation to Cayman, over and over again. And I feel like compelled to reiterate it here, that the Cayman Islands is a perfect example of how you can have fiscal prudence, you can have a private sector-led growth strategy that is underpinned by ease of doing business and a competitive environment that is created by the state, and that growth is led by the private sector and not by fiscal overspending. Unemployment is at a record low in the Cayman Islands right now, around 3%, and that kind of level of 3 to 3.6% maximum is expected to be maintained this year and next year. Cruise arrivals were down 6% year over year from January to November last year, but are still up 8% with respect to the average over the 2015-2017 period. And these cruise arrivals are down. However, there is a referendum that is supposed to happen soon to decide whether or not the Cayman Islands will build a cruise port, which, if that goes through and it happens, then we might see in the years to come, when if the port is built, some increases in their cruise tourism arrivals. GDP is expected to continue to grow at around 2.2% this year, next year, and unemployment is expected to remain low. Fiscal surpluses are expected to continue, despite the fact that the Cayman Islands just announced its largest fiscal budget ever. And this was contemplated, by the way, with no new taxes and with extended concessions that existed prior to the budget being announced. So all good things happening in Cayman Islands, and things that other countries in this region should take note of and emulate. Moving on to Cuba, conversely, a lot of unsettling news coming out of Cuba in terms of tourism from the US having dropped 17.6%, and overall stayovers were down 8.5% through November last year. And as a result of this, and the result of Venezuela continuing to suffer its own crisis and not being able to support Cuba, we are seeing the external accounts income in Cuba continuing to deteriorate, to the extent that foreign exchange is likely to be rationed even more tightly. This year, they're expecting to assign foreign currency based on priorities such as food, fuel, medicine, fertilizer, and food and fuel accounting for 40% of imports. So rationing foreign currency, of course, suggests that there is a challenge with respect to the level of foreign currency coming in. FDI has consistently missed targets, and so has tourism. So this is a difficult time for Cuba, and likely to continue insofar as Venezuela is also going through its own crisis. Moving on to the Dominican Republic, apart from Guyana now, the Dominican Republic has been consistently the fastest growing economy, not just in the Caribbean, but also in Latin America for several years, growing at around 5%. And this is based on strong private sector credit growth, based on flexible and also accommodative monetary policy. Tourism arrivals were affected, but the impact on foreign currency receipts was offset by remittances and foreign direct investment in the Dominican Republic. Credit to the private sector was growing at a pace of nearly 12% year over year to mid-December last year. And so this is likely to continue into 2020. Remittances for the 12 months to November last year topped $7 billion, nearly doubling the annual remittance flow that was received, for example, in 2010. For January to September last year, foreign direct investment grew 7% year over year to $2.25 billion. And the monthly economic activity index in November grew by 5.5%. So the Dominican Republic is expected to continue to show strong growth in the coming years. Switching to Guyana, Now, if you look at this chart, you will see just how huge the growth is expected to look like this year. Guyana has around 6 billion recoverable barrels of oil, and against a population of just under 800,000 people. And just recently, a couple of days ago, Guyana celebrated 1 million barrels being produced. And they celebrated with lots of fireworks and fanfare. But honestly, I can't help but worry about Guyana because just today I'm reading an article about how the IMF is trying to help Angola and other countries around the world try to diversify away from their overdependence on oil. And this is a challenge that Guyana is aware that other countries, neighboring countries like Venezuela, like Trinidad, are facing. And we would hope that their policy agenda over the coming years will not affect, we hope that the policy agenda in the coming years in Guyana, I should say, would take full cognizance of this challenge and this predisposition for oil producers to suffer from the Dutch disease and will counteract this measure. So, for example, oil is expected to account for 40% of GDP by 2023 into 2024. And the IMF wants to develop, for example, a complementary fiscal framework to support development of the huge human capital needs that Guyana has. Education is lagging, infrastructure is weak, capital spending needs to be ramped up. But to avoid the Dutch disease, the IMF is working on a fiscal target for Guyana to allow it to meet its development needs by focusing on the fiscal deficit as a percentage of non-oil GDP as opposed to total GDP. There is going to be an election in March of this year, and in the meantime, political uncertainty and weak institutions do not bode well for meaningful social outcomes based on the oil revenue. But we continue to hope that with the help of its friends and its neighbors, and hopefully the new incoming government or incumbent, as the case may be, will continue to focus on insulating Guyana from potential Dutch disease and other ill effects of a resource boom. Moving on to Jamaica, of course, like Cayman, very good story here in the region. Really successful recovery and transformation that has taken place over the last few years in Jamaica, to the extent that Jamaica has the lowest and most stable inflation it has ever had. It has the lowest unemployment it has ever had, and consistent stability in its macroeconomic fundamentals. So really, really laudable and commendable macroeconomic outcomes here in Jamaica, and something that the authorities and successive governments need to be congratulated for. Now, what Jamaica has to focus on is making sure that these macro outcomes can then be applied and translated to better social outcomes. Because I believe that unless these social outcomes, meaning reduction in poverty, reduction in crime, for example, I believe these social ills can threaten the hard-won and tremendous macroeconomic gains that Jamaica has seen over the last few years. The economy has grown, for example, for 19 consecutive quarters, and it's not easy, and it's not something that is common throughout this region. So it has really been exceptional. It's now about making sure that these gains can be translated into social outcomes that will then not threaten the eventual continuation of these supportive and positive macro outcomes. Let's switch now to talk about Suriname. So interesting developments recently in Suriname. Fitch just downgraded them a few days ago to CCC. And the governor of the central bank, who's been there for less than a year, just yesterday was asked to resign. amid certain allegations. And it's unfortunate on many levels, not the least of which being that this is also an election year in Suriname. The money supply grew by 88% year over year to October of last year, which means, of course, that the central bank is printing in order to support government spending going into the election. And as a result of that, debt is continuing to increase. And of course, the currency is overvalued. The black market is thriving. Fitch estimates that the black market exchange rate is actually currently around 16% above the official exchange rate. And if you look historically at Suriname's black market, which is quite unusual, there's an official black market in Suriname, and then there's the official market, which of course are two parallel exchange rates. Now, if you look at the last couple of times that Suriname has devalued, typically when the black market rate gets to around 20% above the official rate is when there is typically a devaluation. I don't necessarily expect that there would be a devaluation before the election, but at 16%, a spread between the official and black market rate, it means that that time is drawing nearer and nearer. The relationship between the money supply and foreign currency reserves, for example, so the ratio between the money supply and foreign currency reserves was 14-1 in October of last year, for example. The government projects financing a deficit currently at around 5% of GDP in this fiscal year, with no signs of a correction, and the average deficit is expected to average 4.6% of GDP through 2023. International reserves grew last year despite deterioration of the current account on the balance of payments, and the current account declined from a 39 million deficit from January to September 2018 to a deficit of 308 million from January to September 2019, nearly an 8-fold increase year over year. The country's gross external debt position rose by $160.3 million year over year in September last year, and foreign currency reserves increased by 163 million year over year. So 2/3 of which was from central government operations. Debt to China increased 10% in the first 6 months of 2019, and China is the top bilateral partner, accounting for 86% of Suriname's total bilateral debt. In November, Parliament approved a raise in the country's national debt ceiling to 95% of GDP. And Fitch estimates that central government gross debt already reached 78% of GDP by September last year. So things look, in terms of the macro framework, things are deteriorating in Suriname. This being an election year, there's unlikely to be massive policy shifts towards more prudence and more fiscal sustainability. Hopefully, at least after the election, maybe these policy measures and corrections will take place. Let's see, fingers are crossed. Finally, in terms of our individual country discussions, let's talk about Trinidad and Tobago. Now, I recently did a video discussion with Mariano Brown, Kevin Ramnarine, and Roger Hossain that you will find on my YouTube channel, and I encourage you to subscribe to my YouTube channel so that anytime there is a video or a webinar, you will be instantly alerted. And this video has gotten quite a bit of attention, and I think it's because of the fact that people are finally waking up to the tremendous macroeconomic deterioration that has taken place in Trinidad and Tobago consistently over the past several years, I would say over the past decade. external accounts continue to deteriorate in Trinidad. We've lost over $5 billion in a net errors and omissions item on the balance of payments between 2016 and 2018. I think this is probably one of the most atrocious statistics in Trinidad and Tobago right now. What this means, folks, is basically the balance of payments, the balance on the balance of payments is supposed to mesh with the change in the level of foreign reserves held at the central bank. And where there is a discrepancy between the level or the balance, I should say, on the balance of payments and the reserves, that discrepancy, which is supposed to be a very small rounding error, if you will, is called the errors and omissions item. However, in Trinidad and Tobago, we have one of the largest errors and omissions items in the world, not just in this region. And there has been a net outflow of over $5 billion from 2016 to 2018 that is unaccounted for, over $5 billion unaccounted for, meaning that this money flowed in, into Trinidad and Tobago's economy via official channels, meaning through the banking sector, for example, wire transfers and so on, but then left in a manner that is unaccounted for. That is, to me, a massive policy failing and an issue that needs to be addressed with urgency, yet none of our policymakers even acknowledge this as a problem. Trinidad and Tobago lost 40% of its foreign reserves in the last 5 years. And if you look at the chart, it's almost a straight line. Yet still, as a policy decision, the authorities continue to maintain an overvalued currency, which means that the US dollar is subsidized, which means that the state is subsidizing imports. And that overvalued currency, by the way, penalizes exports. So our non-energy sector is being penalized and has been shrinking for years. Furthermore, we've had, for the last 2 fiscal years, growth in the size of the fiscal deficit. And so, of course, this is not likely to be reversed in the current year, which is an election year, by the way, as well. The reserves now are currently at the lowest level since 2007, ending last year at about $6.9 billion, which is just over 7 months of import cover. We have lost over $4.6 billion in reserves over the last 5 years. The loss in reserves is coming from, as I mentioned earlier, the overvalued currency, which subsidizes imports and penalizes exports, but also the high levels of fiscal spending, because the more the government spends, the more money leaks out in the form of imports, because most of what we consume is imported. By the way, we also have a black market, of course, for US dollars. Everybody knows that. My understanding is it's anywhere between $7.5 to $8. But notwithstanding all of that, fiscal spending is up, rising 6% year over year, and budgeted in the last fiscal year, and then budgeted up another 5% this fiscal year. We have had an average of negative 0.6% growth, meaning we have had an average contraction of 0.6% in Trinidad and Tobago for a decade. But we have had this alongside fiscal deficits. And this is a perfect example of how fiscal spending and fiscal overspending, fiscal expansionary stance does not generate growth. The budget for this fiscal year is projecting growth of 4% next year. When was the last time Trinidad saw 4% growth, and on what basis are they predicting 4% growth next year? I think it's bordering on absurd. And all of this that I'm discussing here is unlikely to change this year, because there is an election, say, around the last quarter of this year. And so I quite expect a lot of this type of stance to be maintained. Overvalued currency, overspending on the fiscal side, loss of foreign reserves, net outflows in terms of the errors and omissions item, and generally weak investment, unemployment rising, and really no positive traction and no positive movement in overall macroeconomic measures in Trinidad and Tobago this year. I quite expect growth this year and next year not to exceed 1%. That's my projection. I see that other commentators have similar projections. Now let's switch to what are my conclusion and what should we be focusing on in terms of 2020, 2021. What are the big developments that we need to pay attention to? Of course, climate events. And, you know, the IMF once said that out of 511 catastrophes that happened in small states since 1950, over 60% of those occurred in the Caribbean. So what we saw last year in terms of Hurricane Dorian and what we saw in 2017 in terms of Irma and Maria are not going to be exceptional events anymore. These are going to become the norm. And so this is something that we have to find a way to mitigate and to insulate ourselves and our economies and our businesses against. Secondly, I want to talk a little bit about Venezuela. Of course, this is having spillover effects on not just neighboring South American countries like Colombia, but also neighboring countries in the Caribbean. And so some countries are seeing positive effects in terms of labor, greater availability of labor, but also in some countries it puts a strain on already weak government positions. And in terms of broader geopolitical events, we have to pay attention to what's happening politically in the US with an election this year. Of course, the trade wars between the US and China, tensions between the US and Iran, and of course, then there's Brexit and the possible implications of that on a global scale, but also for us as a region. And finally, in conclusion, going back to where I started, this global economy is in a stagnation, which is much worse than just a recession, because it's not cyclical. This is a long-term structural problem I think we have globally. The policymakers have not acknowledged that it's a stagnation, have not acknowledged that this is even a crisis that we need a coordinated policy response to. And this stagnation, therefore, is likely to continue. I think that in order to reverse this, policymakers need to deliberately address the retreat in multilateralism and regional and global cooperation in order to, first of all, unite in a policy response. And in that policy response, we have to deal with the obscene levels of wealth and income inequality that I think is underpinning this stagnation. And this level of wealth and income inequality actually came about as a direct result of the policy response to the global financial crisis. So in other words, the policy response to that crisis has created this crisis, which we are not acknowledging as a crisis. Several elections in the region and in the US suggest, for example, that uncertainty will be higher this year. And that uncertainty causes people to adopt a wait and see attitude. So confidence is affected and therefore investment is affected. And of course, investment is critical for growth. Most of the Caribbean, however, is already growing moderately. But we're not likely to see those countries that are going through elections to show meaningful policy shifts, nor are we likely to see meaningful investment in those economies. So the current pace of growth is likely to continue, but not to accelerate in the region, in my view, except for Guyana and, as I mentioned earlier, for Barbados. Suriname's economy, as I mentioned earlier, is deteriorating rapidly. The recent oil finds, however, will not solve the problem if the macroeconomic fundamentals are not addressed and put on a sustainable path. But what the recent oil finds will do is mask the underlying problem, as we've seen happen many times in not just Suriname, in Trinidad and in other economies. So I think even though Suriname has found all of this new oil, this is not likely to serve them well, in my view, in terms of getting their macro fundamentals right. at least not before the election. And finally, in terms of Trinidad and Tobago's outlook, I just want to end by saying that in my view, Trinidad and Tobago is the next most likely country to hit a balance of payments crisis in the region and to default and to require an IMF program. Given that there is an election this year, I'm not predicting that that will happen this year, but I'm thinking maybe next year, maybe into 2022, if things can be held together until then. But my prediction is that Trinidad is the next most likely default. And on a regional scale, that's something we have to think about, because Trinidad is one of the bigger economies in the region, and there are likely to be spillovers as a result of that. So I think that this is something that business people and policymakers who have exposure to Trinidad and Tobago need to be thinking about in the next year or two. So I thank you for taking time to spend listening to me talk about the global and the regional economy, and what things are likely to look like in 2020 and beyond. I encourage you to go on to marladukharan.com/insights and sign up for my free Caribbean economic report, and also to subscribe to my YouTube channel so that you can be kept abreast of everything I write and everything I discuss in terms of webinars and videos. I hope you find this useful, and I encourage you to send feedback. I enjoy getting your feedback in terms of what you're interested in hearing about and the topics that you're interested in discussing. Thank you very much, and have a great 2020.